Hello, I'm Dan Ramey, contributing editor to Internal Auditor Magazine's Fraud Department and president and founder of Houston Financial Forensics. I am pleased to introduce this episode of Fraud on the All Things Internal Audit podcast, which provides fictionalized accounts of fraud based on actual events.
The Heartbreaking Fraud, Part 1, a Thursday that changed everything. It started on an ordinary Thursday. Joe Richardson, president of JR Plastics, was preparing for the company's weekly payroll. Normally, that responsibility belonged to the company's office manager, Tiffany Smalley, but that week was different. Smalley had unexpectedly called in to take time off to care for her sick child. For the first time in many years, Richardson had to run payroll himself. JR Plastics was a small, family-owned business that fabricated custom plastic products and components. Richardson's father had started the company 50 years earlier, and it had grown steadily through word of mouth and a reputation for customer service. Trust was the foundation of the company. Richardson ran the business much the same way his father had. He relied on instinct, especially when hiring employees. That instinct had led him to Tiffany Smalley. Smalley had worked at JR Plastics since high school. She was the daughter of a family friend, and over time, Richardson had come to see her as part of the family. A decade later, as office manager, Smalley was indispensable. In that role, she oversaw the company's financial administration so Richardson could focus on growing the business. She handled payroll, expenses, and all accounts payable and receivable. Additionally, she performed wire transfers and originated ACH payments to employees and vendors. And she did it all without dual control. Smalley could enter payment information, create templates, pay invoices, and run payroll without Richardson's approval. She also had access to the company's online banking system. In fact, she was the only administrator, while Richardson himself was set up as a user. He logged in occasionally to check balances or make transfers, but day-to-day financial operations were left to her because he trusted her completely. Part 2. Something doesn't add up. The week Smalley was absent, Richardson followed the written instructions she had left behind to run payroll using one of the company's templates. Partway through the process, he had a question about the procedures, but not wanting to bother Smalley while she cared for her sick child, he decided to review previous ACH batches instead. That is when he noticed something unusual. In the first few batches he reviewed, Smalley's salary appeared higher than her normal payroll amount. At first, he assumed it was a mistake. But as he continued reviewing records, the pattern repeated itself. Her payroll amount was consistently elevated. Concerned, Richardson contacted his community bank and requested ACH batch records going back as far as it could provide. When the records arrived, he began examining the transactions closely. Then he pulled the company credit card statements. Part 3. Peeling back the layers. Several charges immediately stood out. There were payments to AT&T, charges to Netflix, and other expenses that were clearly not related to the company's business. The deeper Richardson looked, the more irregularities he found. Next, he began reviewing checks that had cleared the company's bank account. That is when he discovered another problem. When Richardson traveled out of town, he sometimes left blank, signed checks with Smalley in case an unexpected expense came up. But Smalley had occasionally used those checks to write payments to herself. Over time, the pattern became clear. For 2 years, Smalley had been padding her salary, charging personal expenses to the company credit card, and issuing checks to herself. By the time Richardson finished tracing the activity, the total loss exceeded $200,000. He was stunned. More than anything, he was heartbroken. Part 4. The Truth. When Richardson confronted Smalley, he hoped there had been some mistake or reasonable explanation, but the truth was exactly what he suspected. Smalley admitted that 2 years earlier she had run into financial trouble. As a single mother with a small child, she was struggling to make ends meet. She said she initially paid herself a little extra 1 month, believing she could cover her bills and then fix the situation later without anyone noticing. But things did not improve. Soon after, her son became ill, and medical bills began piling up. The financial pressure worsened, and the fraud continued. Part 5. A Hard Lesson. Richardson felt sympathy for Smalley's situation, but he also knew he had no choice. He terminated her immediately. He told her that if she had come to him for help, he would have assisted her however he could. But stealing from the company was something he could not tolerate. Because of his long relationship with Smalley's family, Richardson decided not to press criminal charges. He also chose not to pursue reimbursement for the stolen money. Still, the experience left a lasting impression. Richardson learned that while trust is important in any organization, it cannot replace effective controls. In the end, the lack of oversight cost him more than just money. It cost him trust.
This has been the All Things Internal Audit Fraud Podcast. Fictionalized accounts based on actual events, brought to you by the Institute of Internal Auditors. IIA members can access the full story in this month's issue of Internal Auditor magazine, including bonus materials on lessons learned. To read more, visit internalauditor.theiia.org. For more fraud-related resources, including guidance and thought leadership from the IIA and the ACFE, visit theiia.org/ACFE fraud.